What's up, everyone? Welcome back to Big Markets Think Simple. Quick question. Have you ever heard someone say, just Venmo me? In America, that phrase is basically second nature. You split a dinner bill, you say Venmo me. You owe your roommate rent, you say Venmo me. It's not just an app anymore, it's a verb. And the company behind it, PayPal. Now, take a look at the stock. In 2021, shares were trading at $310. Today, we're sitting around $45. That's nearly an 85% drop from the peak. Revenue's still growing, the company's still profitable. So what happened? Why is the stock in the gutter? Here's what makes it even wilder. PayPal was built by some of the sharpest, most relentless minds Silicon Valley has ever seen. We're talking Elon Musk levels of talent. So how does a company like that end up here? Let's get into it.
This video is not investment advice. It's for educational, entertainment, informational purposes only. I'm not a financial advisor. Please do your own research before making any investment decisions. Any investment decisions are your own responsibility.
You cannot tell the PayPal story without talking about the PayPal mafia. Elon Musk, Peter Thiel, Reid Hoffman, the guys who founded YouTube, Steve Chen and Chad Hurley, all of them were early PayPal. This wasn't just a payments company. It was basically a startup factory dressed up as a fintech. Back in the early 2000s, when online payments felt sketchy and people were terrified to hand their card info to strangers on the internet, these guys built something that said, we'll make this safe, we'll make this work. And they did. The culture they built was intense. Move fast, trust the data, and don't go home until the problem is solved. So if this company was built by all that firepower, why isn't it getting the same respect today? To answer that, you have to look at where PayPal actually makes its money. You've seen it. You're checking out online and it's there. Credit card, Apple Pay, PayPal. You click PayPal, log in, and boom, your payment goes through without you ever handing your card number to some website you've never heard of. That's the core value prop, a secure vault between your money and the internet. As of 2025, PayPal operates in 202 countries, has 440 million users, and processes about $1.79 trillion in payments every year. Yeah, trillion with a T. That brings us to the 5 things PayPal actually does. 1. Branded checkout. That's the PayPal button you see at checkout. This is their bread and butter. Highest margins, most recognizable. 2. Braintree. This one's invisible to most shoppers, but it's huge. Think of it like the plumbing behind the store. Uber, Airbnb, big platforms. They use Braintree to accept every payment method under the sun without building all that infrastructure themselves. 3. Venmo, America's peer-to-peer payment app. But PayPal's bigger vision is turning it into something more, not just split the check money, but your everyday wallet for shopping and financial services. 4. Pay later. Buy now, pay in installments. Big for younger shoppers, great for driving conversions on higher ticket items. 5. Small business services. Using all that transaction data, PayPal offers merchant loans, fraud protection, and payouts. Less payment processor, more financial backbone for small business. Now, here's where it gets interesting. These 5 businesses are not created equal. Some print money, some barely break even, and some are still trying to prove themselves. The real question isn't how much money flows through PayPal, it's how much actually sticks. On the surface, things look fine. Dig deeper and something's off. Revenue growth went from 18% in 2021 down to 4% by 2025. That's not just slowing down, that's approaching stall speed. Even more telling is take rate, basically how many cents PayPal keeps for every dollar it processes. That dropped from 1.87% in 2021 to 1.66% in 2025. On $1.79 trillion in volume, that tiny percentage drop represents billions of dollars walking out the door. The culprit? Braintree. When you're processing payments for giants like Uber and Airbnb, they don't exactly negotiate with their hat in their hand. They demand lower fees, and if PayPal says no, they'll just go to Stripe or ADN. So Braintree made PayPal bigger but thinner, more volume, less margin. User growth has also basically flatlined. Active accounts went from 426 million in 2021 to 439 million in 2025. 4 years, 13 million new accounts. For a company this size, that's not growth, that's treading water. Meanwhile, PayPal's share of online checkout dropped from around 50% in 2020 to roughly 40% in 2025. Apple Pay, Google Pay, Shopify's Shop Pay, they all showed up and took a bite. The thing that made PayPal special, fast, safe, trusted checkout is now basically a standard feature on your phone. And Venmo, beloved 100 million users and still mostly used for free transfers. Zelle, backed by the big banks, processed over $1.2 trillion in 2025 and is pulling ahead fast. In 2020 and 2021, the pandemic was basically free advertising for PayPal. Everyone was shopping online, nobody wanted to touch a keypad, and the stock rocketed to $310 a share, a market cap north of $360 billion. Then came the November 2021 earnings call. CEO Dan Schulman had made a bold promise, 750 million users within 2 years. On that call, the numbers didn't match the hype. User growth missed. Forward guidance got slashed. The stock dropped 20% in a single day. Nearly $100 billion in market cap gone overnight. And it kept falling. By 2023, a new CEO came in, Alex Chris. Fresh strategies, big talk about AI, fast lane, Venmo monetization, but the actual growth numbers still crawling. The board finally had enough, and in February 2026, Chris was out. In came Enrique Lors from HP, and just like that, PayPal burned through 2 CEOs in under 3 years. That kind of leadership instability doesn't inspire confidence. Missed expectations, stalled growth, revolving door in the C-suite. That's how you lose 85% of your stock value even while still turning a profit. Let's be real with each other. Is PayPal going bankrupt? No. A company with 440 million users and $33 billion in annual revenue doesn't just disappear. Is it the dominant force it used to be? Also no. Stripe processed $1.9 trillion in 2025 and grew 34%. ADN is sitting at 53% profit margins. Apple Pay is quietly eating PayPal's lunch in mobile, one iPhone tap at a time. PayPal is fighting all 3 of these at the same time. Here's the gut check question. You're checking out on a new site. You see Apple Pay and enter your card. Do you stop and create a PayPal account? If the answer is probably not, that's the problem PayPal has to solve. That said, there's real upside here if they execute. Fastlane is the most interesting bet. It's not just a button, it's infrastructure. First time on a site, you type your email and your payment info auto-fills. In testing, checkout speeds improved by 35% and purchase conversions jumped nearly 50%. If Fastlane becomes the default checkout backbone across the web, PayPal stops being a payment option and starts being the payment layer. Venmo could also finally start pulling its weight. 100 million users is not nothing. The question is whether PayPal can turn split the bill behavior into real financial product usage. And 25 years of transaction data, in an AI world, that could be a serious competitive edge if they use it right. So here's where we land. Is PayPal at a fork in the road? Does it accept its fate as a steady, boring cash machine that the market yawns at? Or does it tap back into that original PayPal mafia energy, relentless, data-driven, hungry, and rebuild itself into the infrastructure of the internet's financial system? The stock being down 85% doesn't mean it's dead. There's still real weapons in this company's hands, but the era of big promises and missed targets has to end. It's time to show up with results. That's all I've got for today. If you found this useful, hit subscribe and drop a like, and let me know in the comments what you think PayPal's next chapter looks like. See you in the next one.